Why falls are taking flight. India is the fastest growing major economy in the world. In a global economy, pulling along other countries, including a rich one, its GDP growth has averaged more than 8% in the first three quarters of 2023 to 2024. Morgan Stanley and other investment houses have declared that India is one of the best places of investors. Billions of dollars should be flowing into our stock market, right? Well, it's not happening. If we take 2022 to 2023 and 2024 to the date, the net inflow have been very slow and closer to zero. An outflow in 2022 was followed by an inflow in 2023, but in 2024 has seen a next outflow, largely an account of an XDs of $3.5 billion in May, partly caused by the rumors of the poor BJP performance. In the general elections, the markets are which some months seeing big inflow and other big outflow out on balance as only little has come in even and India stature has improved. The main reason has been India's resilience in the face of COVID, the Ukraine war. These three factors have led low many development countries, India's Pakistan, Bangladesh, and Sri Lanka, have all gone to IMF for issues, but India is solid as a rock. The Russian market has crashed. China has been hit by overcapacity, a real estate bubble, and the Western sanction has raised import duty on Chinese EVs to 100%. These have Chinese further proposal even if their initial impact is limited. Stock market in Hong Kong and Shanghai have plumbed in the year even as the India has broken records. Historically, Indian market have been very sensitive to foreign inflow and outflow. FIIs were said to own half the entire flowing shares in the market when they exited the Asian financial crisis of 1997 to 1999. Indian market were pulled the same happening after a doctrine bust on 9/11 terrorist attack in the USA. The only reason FIIs did not exit and massive was there were no Indian buyers. The trend has now reversed completely. Indian stock market are being diverted by massive domestic inflow, not foreign inflow. This was most widely demonstrated during COVID when FIIs excited and massive but domestic investors. The domestic investors came to rescue. The Indian middle class has fallen in the love with systematic investment plan SIP in which they have a certain fixed sum deductive from their salaries every month and invested in the mutual fund. Generally perform badly in stock market, tend to panic and sell when market crash and buy when markets are bloated and about to burst. Experts have long concluded them not to try time the market. The best way is to systematically invest the fixed sum of proper of salary every month. This applies to the self-employed as well as the salaries into an MF and leaves the choice of portfolio to a professional manager. This strategies has proved very successfully in the last decade and has become incredible population. All these factors keep domestic inflow even in the storm conditions. You might think these are excellent reasons of FIAs to cascade into India, but there are women and the domestic investors have pushed Indian stock market so high as to look extremely expensive compared with other investment stock market. One of the biggest MF managers told me 3 months ago, the Indian markets were 8 times more than the Russian, 3 times more than the expensive from the China, and 22.5 times more expensive than the Brazil of for South Africa. I am not sure what criticize he was using for these comparisons, but one thing is clear: India is the king of the BRICS in stock market right now, but preciously because Indian markets are so expensive, FIAs think it should pull out the India and diversity into cheaper emergency market. This has been China a much needed boost recently. 20 years ago, Indian market crashed when FIS exited. This meant FISs could not exit beyond a point without paying a heavy penalty. But today, market provided by the domestic investors means FIAs can exist without paying a step penalty, and many are doing so. Foreign shareholdings in HDFC Bank and ICICI Bank was once close to RBI limits of 74%, but it's down today to 47% and 44% respectively. It is good for the Indian investors to control stock market rather than foreigners. It's good to the long run for foreign investors too, although they find the market expensive. In the short run, India has become a relative safe haven among emergency market